We'll give it just another minute or two before we start. Okay, it's 3 o'clock. I think we can begin. Be mindful of everyone's time. I'm Tony Rolance, Director of Research at Sherman Research, and I've had a pretty eventful February and early March, to say the least. So let's get right into it. I'm trusting everybody can see the screen okay. Um, so we're going to do some market updates, and then at the end, we'll have time for a Q&A. I believe Daniel has something that he'd like to share with the PTK, some hacks that he's been working on in the lab over in, where he's at. So let's dive right in. Okay, again, all of our equity indicators remain on buy signals. The Starflex LS, and StarPath are on the daily time frame, so those are the most reactive. And the Delta V and Galactic Shield, those are the ones that are either can only change on a weekly time frame or even quarterly. To see this, you go to the portfolio toolkit, uh, open up any model essentially, and down below the maximum drawdown chart, you'll see SPL exit strategies timeline. It'll be compressed. And if you click the show button, then it will give you this nice graphic where you can look to see the activity level of the indicators. And based on that, and based on what type of client or an investor you are, you can determine which models that are driven by those indicators are the most appropriate. And what I've done for several months now is I've created a very simple portfolio of just each of the main equity indicators that we have, and doing 20% in each one of them. It includes long-term, short-term, and seasonal. And, and we just run it as a very simple blend. What we get is a pretty decent blend over the last 25 plus years that has a CAGR that exceeds buy and hold, and with a pretty significant reduction in maximum drawdown, which of course is up to debate among analysts on the best measure of volatility. There's various different measures that are industry standard, but I've pretty much come to view the max drawdown as the most accurate for measuring an investor's pain point and when they're likely to react. And I find typically that really 15 to 25% is where people really start getting nervous. So it's good to know your client, and good to know the where they lie, where they're going to start calling with questions. So Moving on. Um, the model also, if you click the show the positions, you can see that we have about 10 to 12 positions there, it looks like, and we're covering everything from large cap tech to international emerging markets to S&P sectors. We also have some small cap value and or I'm sorry, mid cap value in there. And so a nice swath of the equity market universe there. And looking at the maximum drawdown or the equity line, I'm sorry, we can see that the maximum drawdowns are contained within that 20% um, guideline or threshold. So what's been working so far this year? Energy, no surprise, given what's been going on. This was done last Friday, I believe, is closed up 24.8% year to date. And given the present state of war with Iran, I don't see this trade coming to an end anytime in the near future. Risk managed gold is also doing well, up 21.8% since the start of the year. This just probably, in my opinion, speaks to a wider question of fiscal responsibility and money printing going on across the entire globe. So, and then again, gold is a reliable storehouse of value when things in the world get a little nervous like they are right now. Okay, this is along with the front page rankings, the star path indicator table is a good place to also look at and kind of see where the state of the market. And we've seen rotation going on here as small caps and mid caps have um, headed to the top of the momentum rankings. Technologies pulled back quite a bit, which is pretty remarkable. Um, Definitely could sort of speak to a bearish case going forward, but as of right now, all the evidence is showing rotation is what's going on. Again, we see cash at the very bottom, which indicates that pretty much the entire market is still in gear, involved in the uptrend, and we'll be watching that closely. Long-term trend, Delta V remains bullish. We really don't pay attention to the slope of the indicator or it's strictly, is it above the threshold or below the threshold on a buy signal or on a sell signal? And this one is definitely on the months to years time frame. As you can see, there's only been a handful of trades over the last 20 plus years. Kind of a current state of the market, view of the market. We have energy and materials leading the way year to date with regards to sectors. And our front page rankings has picked up on that as we have, again, materials and energy at near the top for the sectors of our rankings. So this is something to be on watch. Very heavy retail participation. I think it's a largest retail flow in history over the 21-day period. There at the end of January into February. And not always, this comes from JP Morgan, not always a bullish case because as we know, once retail starts getting heavily invested, they're pretty much the last ones to enter the trade, and there's no more fuel for continued uptrend. So another part of this is a lot of that money went into leveraged ETF products. So definitely something to be a little bit concerned about. Earlier today, VIX was at 21.7. You can see that it went up there and tagged that 28 level when the market sold off yesterday morning. And what's interesting, it was a perfect tag of that 28 level that it's hit 1, 2, 3, 4 times before and bounced and reversed off of it. So we'll see if right now we're back into a safe level, but really anytime we're above 25, things start to get a little nervous. Now looking at the Bank of America Move Index of Treasury volatility, this is at 77.75. 60 to 80 still indicates low volatility and a risk-on environment. Um, it is showing a slight increase over the last 2 weeks, but still its overall signals of expectation of stable interest rates and lower volatility in Treasury yields. So also on watch. This was almost a perfect chart of the rotation that we've been talking about over the last few months. We're showing the MAGS ETF, the Round Hill MAGS 7 ETF versus the S&P 500 equal weight, and we're seeing almost a perfect +7 in equal weight S&P and a -7 in MAGS. So pretty clear, um, pretty clear indication of rotation. Russell 1000, we're looking at the advanced decline line, and a pretty solid uptrend continues. It's showing broad participation in the market. So we're just seeing, even though the headlines are very concerning, overall, um, it's really, I'm from Missouri, I'm from the show me state, so it's show me, don't tell me. What people are actually doing is they're still active in the market. So this one I found from the market stats as the source. It shows that especially just the exact same technical setup that we just had with a VIX over 27 intraday, while the S&P 500 is within 5% of an all-time high. 1 month later, those are all the past signals. 1 month later, the market has been up 92.9% of the time and an average of 2.76%. So again, this intraday and intraweek volatility that we're seeing, not time to panic just yet. This is seasonality since 1950 on S&P monthly returns. We exited February where we had an expectation. We talked about last month that we expected February to be weak. Indeed, it was. But now March is looking to be on average 1% up. So um, I wish it was that easy that we could just use this chart as a roadmap, but I do find that the seasonal trends they are a little more they're more consistent than not. So I still look at them as a reliable guidepost. This is chart comes from data based off of a study done from Carson Research. I narrowed it down to focus on just the last 25 years. The original chart, I think Ryan Dietrich had it going back to about the 1950s or so. But still, the thesis is the same in that 1 month after all of these terrible events that you see that happen, 72% of the time, the market was higher 1 month later, and about 78% of the time, 3 months later. So this might be a good one to pull out when you have a client that is nervous about the headlines, and it's a real reality check of how the market reacts to these kind of events. And I'm sure email me if you need the original from Ryan Dietrich, and I'll get it to you, or you can find it yourself as well. So where are we now? Markets continue to consolidate near highs as rotation continues. Major equity indexes are remaining resilient in the face of uncertainty, which is quite bullish, considering the war with Iran. Seasonality turning positive again, and our trend indicators remain positive. And again, we just follow the evidence, we follow the data. So we're going to remain bullish until proven otherwise. And all of this can change in a very short period of time. As always, we'll continue to follow the indicators and their signals. And this is a good reminder for myself, as well as anybody, is that far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. So Peter Lynch with a great line there of investor fear, often reacting when it's unwarranted. So further encouragement to follow the data. And there's my email. If anybody would like to get in contact with me, that's the best way. I do have a cell phone, but I leave the sound turned off all the time. So feel free to fire an email at any time. And I think that's it. Um, Daniel, are you on the line? Did you want to share anything?
Yes, I am. I will need to share a different slide set though.
Okay.
Just a moment. I've got a couple of technical difficulties.
Yeah. I can jump in here and say something really quick. Hey,
Perfect.
this is Zach. I've been working heavily with our performance data, trying to get like a composite performance that we can share with any of our prospective clients from the real dollar performance from the TAMP. And I've sent emails out to anyone that I am like trying to get clarification on accounts and making sure that I put them all in the right place for the performance reporting. So if you get an email, please respond to me. And we've got some from me and some from Matt Quigley in the past. And yeah, as soon as I can get that done, we'll have performance reporting for you guys so that you can share with your clients moving forward. Thank you.
Daniel, are you think you're going to get it or do you want to hold off?
Yes,
Oh,
I am. I think I've got it
okay. All right, great.
right now. All right. Is the screen share coming through?
Yes.
Okay. Uh, oh, okay. I think I shared the wrong screen here. Sharing. Share. All right. So today, we're looking at how to take a traditional modern portfolio theory or fame of French or all-weather portfolio and turn it into a tactical portfolio. Some of you have expressed that you want shorter-term indicator with market participation on a strategy. And so that it tracks more closely to what clients are used to rather than having so much time out of market. And so this is a custom solution that you can use that does that. So basically, we're going to be taking the existing client allocation, or the existing allocation of a standard built portfolio, and then just add tactical exits over it. Our first example is the Vanguard modern portfolio theory buy and hold. We've got 48% S&P 500, 12% mid cap, 10% small cap, 10% international, and 20% bonds. And we can input that into the portfolio toolkit using a custom blend, use the fund tickers, and just add in the tickers as desired. And then we can convert that by instead going to create a custom blend, use custom models, create a new model, and then we're going to add the ticker. For each ticker that would have been added to the portfolio, we're going to create a custom model. So we just add in the ticker down at the bottom here with portfolio if no rows match. And then we add in the exit with Starflux long, short, negative. And this is only out of market about 10% of the time. It averages one round trip trade per year. Although that usually ends up being one trade, no trade 1 year, and then 2 round trip trades the next year if there's a high volatility year. So that's about how it averages out. And then we put in an exit to cash there. And you can see, oops. We do, and then for if it's a bond position, we're going to do the delta V bond is negative to cash for that rather than Starflux, because Starflux is for equities only. So you can now see we have one model for each ticker, and we input the same allocations, and then we can compare how the buy and hold versus with the tactical, and you can see we have a significantly lower max drawdown. We have a slightly higher CAGR, and we have very comparable performance to the S&P. Well, not to the S&P. We have comparable performance between the two, and in some cases even with the S&P. So that's a case of a modern portfolio theory conversion. Now we're going to look at Fama French. Same thing, we have the tickers. We convert those tickers into tactical models. And then we have the comparison here. And once again, higher CAGR, lower MDD, and comparable performance over time periods due to the higher participation in the market, even in out-of-market periods. Well, because of shorter out-of-market periods. Here, we're looking at adding in gold to Fama French, since a lot of people are wanting to add in some commodities. So traditionally, you would reduce the bond by 5% and add in gold. We take a slightly different approach by reducing the bond by 5%, but then exiting from gold to bonds if gold is negative, since gold is only in market about 2/3 of the time. So it's a slightly more complex. We have two indicators with our gold as our primary, and then to bond. And then we also reduce the equity position a little bit and add in gold. So we have a total of a 15% gold allocation here. And we do gold and then uh, exiting the um, to the equity position. And actually, I have the wrong build in here for the equity position. The equity position actually mirrors that was used in this. It actually mirrors the equity position in the rest of it. So it's going to be 35. That equity out of market is 35 at 30.5% S&P, 70.5 small cap, etc. Well, actually, no. Well, it's adjusted by the equity, so it's a little bit larger than 30.5. Will get a corrected slide out after the presentation. But then the allocation you can see here, we have substantial outperformance with substantial risk reduction and comparable participation. Here is an all-weather. With all weather is heavy on treasuries and a gold to commodity mix. Uh, and then for this, we once again increase the gold allocation a little bit and reduce the bonds with with the treasuries so that it's gold primary and then treasuries as a secondary. And here you can see, once again, we have outperformance, massive risk reduction, and substantial increased performance over various time periods. And that's everything I have.
Okay, great. Thank you, Daniel. There's a lot to unpack there, and definitely, I love the versatility of the toolkit that we have. I think it's a pretty incredible tool in the industry. So, um, okay, we got Paul. Yes, sir. Let's see. Trying to get you unmuted, Paul. There you are, I think.
Hi, can you hear me?
I got you, Paul. How you doing?
Great. I'm fine, Tony. How are you?
I'm doing good, sir.
Great. Hey, Dan, um, I'm, uh, I was just wondering if you could go back to that last illustration. If your slides are not available, that's okay. Maybe we could do it offline, but I wasn't quite sure when I took a look at the performance,
Yes.
it looked like the model portfolio. Well, here we go. So in other words, the all-weather tactical is gold. So it has a 7.9 KGAR and a -10 drawdown.
Yes.
And it looks like 100,000 grows to
4.8.
484,
Yep.
and the S&P grows to 833.
Correct. The
Okay.
all-weather strategy is a much more conservative strategy
No, I get
than
it.
you're traditionally you're sitting in 55%
Right.
treasuries with only a 30% equity exposure and then 15% in gold and commodities.
Right. So what would be a better benchmark than the S&P to show on this? 55,
I mean,
55, 45 or 60, 40?
yeah, or or 70/30 even.
Okay.
Um, it
Well,
all weather is
which
a
model?
little hard to compare to really traditional unless you're all weather is something that you traditionally use
Mhm.
because of that large commodity slice that has
Right.
low correlation with the rest of the market.
Yeah. So I guess what I'm saying is that S&P 500 really is not. I mean, it's not a good comparison. It's not a good benchmark. I mean,
No,
the
the
seven. The,
I used S&P in here. Really, we're benchmarking the tactical against the traditional buy and hold, and the
yeah.
S&P in there is just for recognition as far as what the rest of the market was doing over those periods. Um,
Correct.
so if you're gonna, you know, if I were to do this for a client, I would put in the, whatever their portfolio is, like the all weather that they're coming over with as the benchmark. I would build that out as the benchmark, and then I
Yeah.
would put the tactical as the model that's being compared to.
Yeah. One suggestion would be, I think for an illustration like this, the S&P should be replaced. You shouldn't even show it, or it should be replaced by a more comparable benchmark, maybe just based on standard deviation or however you decide to do it. And it would
Yeah.
be nice on the toolkit if we could show two. In other words, show the 100,000 growing to 484,509, show the 70/30 or the 60/40 growing to whatever it's growing at with this drawdown, which is less than
And
55.
you can do that. You can select a single benchmark that you're showing comparing against both, and then
Right.
do two models
Hmm.
that then show up on the same page, so that the graph would
Okay.
overlay for all three, um,
Okay.
and they would each show against the benchmark. So there's ways
Hmm.
around that.
I
And
think
if
one
you
one of
if you
these
want to
is,
book a session where we can go over that in more detail, we could have a call off,
yeah,
where we just go over that
that
specifically.
would be great. I think the other thing is when you're when you replace the S&P 500 with a custom index, let's say a 70/30 or a 60/40, you sometimes lose the statistics on the page that you get when you have the S&P 500. So I don't know if it's possible to recalculate the statistics using a custom
Off
benchmark.
Usually, the reason for the loss of statistics on the custom benchmark is because the
Yeah,
tickers used in the custom benchmark don't have enough history. So
yeah,
if you use a benchmark that has like 10 years of history, but your model has 15, then that can
mhm,
cause an issue where the statistics for the benchmark don't display properly.
yeah. Okay.
Okay,
All
I
right.
think,
I,
yeah,
I'm
thanks
sorry.
a lot, Paul. I think
I
to be
found,
mindful of
I'm
everyone's
sorry,
time
just
and
one more
schedule.
thing. I found
Okay,
that when I changed the custom benchmark and I use the ETF symbols that we actually use in the models, I still don't get the statistics. Just I may have to
Oh,
figure that out.
okay. Well, let's talk about that later. Because I haven't seen that issue, but if there's an issue there, we should get it fixed.
Beautiful. Thanks,
okay,
Dan.
great. All
Thanks,
right. Well,
Tony.
thank you for everyone's time. We're going to wrap it up. And again, feel free to reach out to any of us at our email addresses is probably the best. And we'll do our best to get you the service you need. So thank you very much and have a great month.
Terrific. Thank you.
Thank you.